You're listening to Counsel That Cares, a podcast series brought to you by Holland and Knight's Healthcare and Life Sciences team. With more than 400 attorneys practicing across the healthcare industry, members of our Healthcare and Life Sciences team are on the leading edge of industry developments. This series serves as your personal checkup on the multifaceted playing field of healthcare law and business trends. Welcome to Counsel That Cares. This is Morgan Ribeiro, the host of the podcast and a director in the firm's healthcare practice. Today, we're diving into a topic that remains a bellwether for the industry's health: bankruptcy trends. Joining me are three experts who have lived and breathed these numbers for years. First, we've got Clare Moylan and Ron Winters, who are principals and co-founders of Gibbins Advisors, and my colleague Tyler Layne, a partner in our restructuring and insolvency practice. Clare, Ron, and Tyler, it is great to have you all back on the show.
Thank you very much.
Thanks for having us.
Always a pleasure.
So before we launch into our discussion today, I want to hear from each of you, just for our audience's benefit, a brief introduction. And Clare, would love to also hear just a little bit of background on Gibbins Advisors.
Sure. So Ron and I founded Gibbins Advisors. That's Gibbins for everyone who always spells it wrong, but understandably so. So we founded the firm in 2019, and we just saw a gap in the market to focus on healthcare's middle market in restructuring. There's a lot of providers out there who have financial challenge and they don't have the skill set within the management team to be able to handle some of those, especially balance sheet issues. And some of the really large firms who we really enjoy working with as well, just tailored for bigger sized organizations. So we started the firm to focus really on, community hospitals, rural providers, and smaller groups of healthcare facilities, and also working with lenders, creditors, and other stakeholders, all dealing with the same types of issues that I think we'll cover today, which is around some of the challenges that healthcare is facing on a macro level, and then we see it materialize down to the company.
Excellent. Thanks. Well, thanks for being here. And Ron, anything you'd add to that?
Claire hit it pretty much on the head. I've been in the restructuring business for 25 years, having been a secured lender and workout guy before that. And as Claire said, what we do is we're able to handle engagements that have a bit of complexity, but perhaps don't have the heft that the very large firms need to support them.
Tyler, as I mentioned in the intro, you're a partner here at the firm. You want to provide just a brief overview of your practice and the work that you do as it relates to today's topic?
Sure. As Morgan, you said, I'm a partner in our restructuring group and work predominantly in the healthcare industry on the provider side. So hospitals and health systems, senior care, physician practice management, and the like. And I work with companies, sponsors, and lenders who are navigating liquidity issues or going through an out-of-court restructuring or Chapter 11 or other type of in-court restructuring, including buying and selling assets out of those proceedings.
Awesome. Well, thank you for that. So as I mentioned in my introduction, Gibbins Advisors puts out an annual report on healthcare bankruptcies. And Claire, I'd like to start just with the headline. The latest report for the full year of 2025 shows that healthcare bankruptcies actually fell a little over 20% compared to 2024. Can you tell us what's behind the numbers at a high level?
So we started tracking pre-COVID to understand, what was happening in healthcare in terms of Chapter 11 bankruptcies by subsector. We didn't see anyone else doing that in the market. And for our own purpose, we thought, well, let's look at it. And it turns out that a lot of people across the country find the information really useful. So we provide the report for free. People can go onto our website and find it. We only look at the companies that file bankruptcy where they have over $10 million in liabilities. So it doesn't include a lot of the really small company bankruptcies. So it's just where you've got over 10 million of liabilities. And it's only Chapter 11 bankruptcies. So where you might have Chapter 7 filings, that's not included in the numbers. And what we've seen over the past several years was through COVID, there were much fewer bankruptcies because of the influx of government support funds that provided struggling providers more cash than they'd seen in a long time, which was terrific to really help weather the storm of a pandemic. That's what you want. So we saw fewer bankruptcies through that period. And then post-COVID, in 2023, there was what we now see as a bit of a spike in the data. So there were 79 cases in 2023. That fell in 2024 to 57 cases. And interestingly, in 2025, we were surprised, honestly, that it fell again to 45 cases. And it's surprising to us because we feel a lot of distress in the healthcare sector and we're seeing a lot of distress. So maybe we can talk in a minute about some of the reasons why the numbers might be going down. But I will also mention just a technical thing, that the way that we count the cases is that one enterprise that files bankruptcy is counted as one. So they may have 100 subsidiaries that also file bankruptcy. That's not counted as 100, that's counted as just one case.
Great. That's helpful to better understand the data behind those numbers. Ron, I'd like to turn to you. I mean, this all sounds like really great news, but your report suggests that we shouldn't get comfortable with that. Why is that?
It's hard to look at one quarter as being really reflective of anything. In the 6 weeks of this year that have transpired so far, there've been 9 filings, which suggests a bit of an upward trend. I think some of this is based upon things and availability of credit and things you see in the credit markets that maybe go beyond the financial health of the healthcare companies, the providers themselves. Another thing you need to keep in mind is that a good amount of workouts that we see, again, as Claire said, we're really only tracking hospitals and other healthcare providers that are in bankruptcy with liabilities of $10 million or more. In this country, there are a lot of much smaller bankruptcies. There are no subchapter 5 bankruptcies in there because it doesn't meet the debt requirements. A lot of the cases that we see, particularly, say, in senior living, particularly in maybe nursing homes, are done in receivership state court proceedings as opposed to bankruptcy court. That kind of a business is conducive to a receivership, fewer creditors, basically a secured lender or a landlord. Much easier and cheaper to do than a bankruptcy. A lot of the things that we see is that, as we said, actually, before we started to hit the record button, a lot of things really happen very quickly sometimes. Liquidity crisis can kind of pop up out of nowhere, and it causes need to go into bankruptcy. And as I said at the beginning, my remarks just now, is issues in the credit markets and the drying up availability of credit for our clients, for healthcare providers, can precipitate problems, even if there really hasn't been no fundamental change in the healthcare company itself.
Especially the bankruptcy counts doesn't necessarily show the whole picture because there's also out-of-court negotiated workouts. And I'm hopeful that the data is actually showing that people are getting more proactive in dealing with things earlier and not waiting until they're out of options. But out of court is a growing sector of the market. Is that what you're saying as well, Tyler?
Definitely more broadly within the restructuring market, the trend is to do as much out of court as possible. But I think you're seeing a couple of things. As Ron said, certain sub-industries within healthcare, like nursing homes, like behavioral or any type of senior living that lend themselves to receiverships, which tend to be faster and cheaper than a Chapter 11 would be. And even, in behavioral, there's the possibility to even evict the provider and change the provider that way rather than going through some sort of proceeding. And then you have the physician practice management, for instance, where the goal is to always stay out of bankruptcy and sort of do that behind the scenes because you risk losing your revenue generators, in a bankruptcy if they get spooked by the prospect of a long, expensive public process. But to take sort of a less optimistic view of it, I don't know that it's necessarily that people are addressing more problems out of court more than it is there's a lot of indecision in the marketplace as a result of the cost of bankruptcy. A lot of companies that might benefit from a bankruptcy, no one really wants to write the check And so there's a lot of indecision among the stakeholders, and we're still seeing a lot of kicking the can down the road, as you have been the past couple of years, and just avoiding addressing kind of the root problems and just dealing with almost a series of emergencies as they arise. And so I do think that, while the healthcare industry, like every other industry, is sort of getting wise to the fact that there are other alternatives other than filing a company for Chapter 11, seeing what happens, I do worry that we haven't seen the magnitude of distress that we're going to see because of that indecision that is directly cost related.
Interesting. So we've got a little Claire's glass half full. Tyler might be a little bit more glass half empty. So if the bankruptcy filings don't really tell us the full story, what are you seeing, Claire, in the market that gives us indicators of distress in healthcare?
What I do agree with Tyler on, and I don't disagree at all, actually, but the outlook for the amount of distress that we expect to see is concerning. I'll borrow from Fitch, actually. They had a nice way of describing the market of nonprofit hospitals recently, and they're saying a trifurcation in the market. So splitting into three segments where you've got the top 20% with strong balance sheets and located in growth markets. So they're pretty good, the top 20, the middle 65 stagnating, and the bottom 15% deteriorating. So there's this widening of the gap between hospitals that are in pretty good shape and then the have-nots. And the have-nots that we see more concentrated in standalone and rural providers where they just don't have the cash reserves. They're building up liabilities on their balance sheet to vendors and secured parties, and they just don't have the cash to withstand some of the headwinds. Margins, profit margins. Kaufman Hall does a nice job of reporting on hospital profit margins every month. And they reported that last year, the end of the year, November year to date, profit margin was 2% for hospitals. So you're not really looking at strong margins that give you enough to build up reserves of cash or really cover CapEx. But that's also the median. And so if you think about this widening gap of the haves and have-nots, you've got people that are higher than 2%, but you've got a lot of people that are lower than 2% that would be going into negative territory. And even if the bottom 15% are distressed, when you've got several thousand, I think it's over 6,000 hospitals in the country, having 15% that are deteriorating is distressed is a lot. So we think the outlook is very challenging, and there are some policy headwinds coming that will make the situation even harder.
Definitely. And we can dive into those policy issues here in just a bit. Tyler, from a legal and restructuring perspective, what's driving some of that polarization?
It's really a difficult combination of unsustainable balance sheets and a lack of reliable revenue. Healthcare is an inherently middle market industry, and a lot of these providers are carrying debt loads, even if they've been through some sort of restructuring, that aren't sustainable, particularly given where interest rates are and where it appears interest rates will continue to be for some time. And then you're seeing on the other end, on the revenue side of the spectrum, a rise in payor denials, and from a balance sheet perspective, costs continuing to rise faster than reimbursement rates, which has been the case for some time. That just leads to, unsustainable margins that compound over time. And without cash, which a lot of these providers don't have other than the largest, most well-heeled providers, you're stuck between a rock and a hard place of covering those losses and servicing your debt, and eventually the liquidity just dries up. And it is more acute amongst the smaller providers or smaller systems, and in certain industries like senior living, where it's been, reimbursement rates have been a problem for some time.
Going back to what we just discussed, the report specifically calls out 2026 as a potential pinch point due in large part to the new federal legislation. Do you want to talk a little bit about what providers should be bracing for due to the federal legislation?
So the legislation I'm talking about is the so-called One Big Beautiful Bill Act. Most people that are probably listening in are familiar with the substance of what's coming, $1 trillion in Medicaid cuts over the next decade. Starting in 26, it's already starting to have an impact on providers, for example, where you have supplemental payments, having federal CMS approval for each state's supplemental payments program. Some states have got approvals already, but some others are stalling. That will impact how much in supplemental payments these hospitals can expect to get. And some of them really live or die on those supplemental payments, especially where you've got a high Medicaid population. There's escalation of the impacts of the One Big Beautiful Bill Act over the next few years as it really hits the healthcare coverage. So increasing requirements for Medicaid beneficiaries to qualify more frequently will result in fewer people with Medicaid coverage, and that will put pressure on hospitals that continue to need to treat patients that don't have that insurance. They may fall off. Additionally, there's the Affordable Care Act premium health tax credits that are currently expired, but it is a really hot issue at the moment. And the House has passed a 3-year extension request, and it's still, as I understand, at the moment, here we are in February, still in debate at the Senate. But the impact of those credits expiring is that people are falling off having private health insurance that they were getting through the state exchanges. And for example, I just saw something the other day that California enrollments were down, I think, 20 to 30% on 2025 levels. So that's just enormous as an impact. So when providers look at their business and see, well, what's the impact of this as it continues to be implemented? What's the impact of the legislation as it's implemented over the next several years? And how will that impact our revenue streams and costs? It's a very significant impact, particularly on safety net hospitals, which are the hospitals that are called a safety net because they serve a disadvantaged population.
Well, I think, Claire, to your point, I mean, there's still so many unknowns, and it's hard for some of these organizations to even plan for that, unknown future, just, as it relates to the ACA credits, for example. Ron and Tyler, I mean, that's a big topic. Or Claire, I don't know if you have anything else to add to that.
I was just going to say that with the uncertainty, I would suggest for providers to really look at conserving capital. Just not knowing what's to come and planning for the worst is just modelling out that impact and making sure that the way that you prioritise capital, that you're building up some reserves just in case.
I mean, One Big Beautiful Act is, of course, getting a lot of attention, and, the Medicaid component of that was noteworthy. But there's obviously a number of other things happening at a federal level as it relates to reimbursement that are impacting these providers and, can certainly impact what we see in 2026 and beyond. I want to jump into some of the subsectors that you all highlighted in the report. One that we've touched on already is the senior care space, which seems to be struggling more than most. Ron, you want to jump in here and share with us what you're seeing in the senior care sector?
Morgan, that's exactly right. And I would probably expand beyond just the senior living or senior care to post-acute generally, although we don't isolate that in our report. Post-acute might, for example, include LTACs, long-term acute care hospitals, which for a long time have been the subject of Medicare and payer controversy. And we're seeing a good amount of activity and distress in that area. With respect to senior care particularly, we saw about an 18% increase in 2025 over the prior year in terms of number of bankruptcies. And for the first time since we started doing our report, there were more senior care bankruptcies than pharmaceutical bankruptcies, which had been, for a number of other factors, we had seen quite a few bankruptcies in the earlier years. Talking about senior living, though, particularly with respect, Morgan, to assisted living and independent living, one of the things you're kind of seeing now is sort of the flip side of some of the general economic dynamics, because construction costs have increased so much over recent years. we're seeing fewer new entrants in the markets, which can help particularly some of the weaker players in senior housing. I mean, one of the things that we frequently saw, facilities that became uncompetitive as they aged because they're less regulated than, say, hospitals or nursing homes. Investors could construct new ones without much in the way of barriers except getting the money. Now that the costs are so much higher, fewer of them are being built. And so I think that's going to help some of the weaker players. Nursing homes always have problems. I think people are aging in place more and more. When they go to nursing homes, it's later in life for shorter periods before they, for the most part, sadly pass away. But nursing home business is more regulated, has more costs than, say, an assisted living business. And as a result, you have to have pretty high occupancy to make it. And as a general matter, one of the things that we're seeing is that it's difficult in a big country like the United States to talk about a trend. The national trend does not necessarily reflect what we're seeing locally. One market that might be doing quite well, a nearby market or in a less affluent place or where demographics are changing or the population shifts are occurring, they might be doing far worse. One other factor that I should have mentioned before, one of the things that particularly in the nursing home business suffered from was particularly coming out of COVID, was much higher labor costs as they had a greater reliance on agency or traveling nurses and techs. We've seen that come off quite a bit in recent years. But at the same time, one of the recent surveys showed that a lot of nurses may be burning out. And there's a recent AHA survey that indicated that a good amount of our nursing population intends to retire in the coming 5 years.
Both of our firms do a lot of work in the hospital and health systems sector, and that was another area highlighted in the report. Beyond what we've already covered, Clare, what does the data in your report signal about bankruptcies in the hospital sector?
So for hospitals, we did see an increase in the number of bankruptcies that were filed in 2025 compared to 2024. So remember, the headline was that the bankruptcies came down. Well, across senior care, they went up slightly, and across hospitals, they went up from 5 to 8. I'll notice that it was not the number of hospitals, it's number of hospital sector enterprises. So firms like Prospect Health with many hospitals were counted in our data as one. I think when you look at the outlook for hospitals in light of what we've been talking about today, there are challenges on all fronts between the cost increases, reimbursement declines, payer denials, and cash flow pressures. And I expect that distress will continue. It may come up in the bankruptcy filings, but we may also not see it in the data count here, and it'll be dealt with out of court or in other forums. But I don't see a kind of end to the pressures. So it really puts challenge to management teams to say, okay, look at what you're dealing with. And it's been challenging for a long time. And I think the industry is very resilient and adaptable. And what creative solutions might come out of these challenges, there's a lot of talent in the country, and we'll see how people really grapple with these headwinds. So I think you do expect the distress situation to continue, and not every hospital will make it, unfortunately.
We talked about the One Big Beautiful Bill earlier, and of course, a component of that is the rural transformation dollars. You see that impacting, because in particular, it's these kind of smaller, standalone, often rural facilities that are being hit hardest. Kind of feels like a Band-Aid on a larger issue. Does that really solve for the larger issues we're seeing here?
From what I've read about it, the intent of it is to put dollars toward transformation, and that's really what everybody needs to do. So it sounds good. The way that it gets allocated is interesting. It's not based on a rural population, for example. Some states get a much, much higher dollars of the funding per rural resident than others. So for some, it's very meaningful for some states, and for some other states, it's really not much relative to the size of their rural population. Also, the way that the funding is channeled is at the moment to go through states, and then the states allocate the funding out. So there's not really, as far as I can see at the moment, transparency as to how it actually gets to the providers and who gets the money and who doesn't. We don't know, and we can't rely on that channel of funding at the moment as a solution for all rural hospitals. The quantum of the funding is reportedly far lower than the hole that's created by the funding gap elsewhere. So it's got a nice intent around transformation, but it won't be the silver bullet solution, and it won't necessarily help all rural hospitals.
We talked a lot about haves and have-nots within the hospital industry and the sense of cash. Another thing that you see a lot is haves and have-nots in the sense of technology and innovation. And it's basically becoming sort of table stakes to, be the most technology forward, innovative hospital in order to make it. And I think a lot of the rural health transformation project is meant to bring a lot of these hospitals that have deferred capital expenditures in technology and innovation to the point where a lot of the larger, more financially stable facilities are. The problem with that is that if you can't make payroll in 2 weeks, it doesn't matter. And so without fixing the underlying cash flow problems, you're never going to see these facilities survive to the point where that transformation can really take effect. It's a little bit like putting, a V8 in an 86 Corolla. It's great. You can go fast for a couple of days and then it's all going to fall apart. So that's my main worry, in addition to what Clare said, which is the quantum just isn't nearly sufficient to make up for the Medicaid cuts.
I'll add to that too, Tyler, is that the funding has a cap on the amount being able to be used for patient care. So if you talk about hospitals that are losing money and need a cash injection for patient care, it's not for that purpose. At least 85% of the funding is not for that purpose. So I agree with Tyler that the challenges for some of these hospitals, the intent is good, but the practicality of it is a different thing.
That's an excellent point. Tyler, you've mentioned some of this, but you do a lot of work with clients that are struggling both in the senior care and hospital sectors. Are there any other particular operational or financial issues that you have not already discussed that are causing this strain?
As Ron mentioned, I think for hospitals in particular, the labor costs have stabilized. They've stabilized at a much higher level than they used to be, but at least they're not skyrocketing. But other things like pharmacy spend are skyrocketing in its place. And then when you combine that with the higher denial rates and sort of payors tightening their belts a little bit in this environment, that's going to be a dangerous combination for hospitals. And the denials in of themselves are a cost because you have to pay a team to work that AR, and that's going to be an expense in and of itself. And then in senior care, it's just still staffing. There was sort of a panic over the federal minimum staffing rule that came into effect. That was repealed. But you're seeing a very Medicaid heavy industry get reimbursement rates slashed, and the facilities are already having trouble staffing to an acceptable level. And so, you really, as a stakeholder in those types of facilities and hospitals, need to figure out how you can generate free cash flow and really how you can minimize expenses that aren't necessary in the near term, which unfortunately can compound some of the problems that we were just talking about on technology and innovation.
Ron and Clare, I want to go back to you guys. In the report, you focus on strategic transactions and how that's allowing for resilience and market positioning. And that's a really important consideration as these organizations prepare for, I'd say just in general, what's happening with reimbursement and the regulatory environment, but in particular, the impacts of the One Big Beautiful Bill Act. Can you elaborate on that?
What we saw in hospital and health system M&A in 2025 was a surprising reduction. I think at the beginning of last year, we were thinking that there would be an increase in the amount of transaction activity. But with the One Big Beautiful Bill Act being proposed early in the year and then the middle of the year being passed, that uncertainty, I think, led to a cooling of some of the transactions. So, for example, I'm quoting Kaufman Hall report. They were reported announced transactions in 2024 of 72, and then by 2025, that fell to 46. And also the number of financially distressed transactions has increased. So the question that we're seeing is around financial distress and buyers. How many people are really interested in these distressed providers at a time when the strategic buyers are also facing these headwinds? With certainty comes a better understanding about what to expect. And that means that people can price into transaction risk. So there may be more activity in 2026 around distressed providers that actually close. But outside of that, there are also opportunities in the transformation that is required in hospitals. And so where we've seen the shift from inpatient and institutional settings to an outpatient setting, we're seeing a lot of private equity dollars flow towards those types of businesses in healthcare. Technology will continue to be a very important part. Automation and the implementation of AI. So all of these affiliates or healthcare affiliate businesses that really will enable the transformation that has to happen for providers to continue to be sustainable and succeed in the future of healthcare. There's continuing to be opportunities for transactions and investment in those areas.
You all touched on this a little bit earlier around maybe we're starting to see more organizations be proactive or kind of thinking ahead and not waiting for things to, get to the point where they need to file for bankruptcy. We talk a lot to leadership teams, right, about how they should be thinking through these issues and things that they can be doing now versus in those critical moments. So would love to know from each of you kind of what's one thing that leadership teams should be doing right now in this current environment?
From my perspective, not waiting until you're in a liquidity crisis, which any sort of liquidity crisis is just going to minimize the number of options you have. And, these funding cuts are real. And so I think that, any sort of leadership team in the healthcare industry needs to take a pause, take a moment to figure out what the 2026 looks like for them in the best case and what it looks like for them in the worst case. And making those hard decisions based on that sort of critical modeling at this point means that you're going to be making decisions from a position of strength and not one where you're having to make a decision in the middle of an emergency that may lead you to a suboptimal outcome.
So if I had to say what's the one thing, I would agree with Tyler, but probably extend it to not just look at this year, but also the next few years as the implementation of the Medicaid changes would come into effect. Because the strategic transformation that you'd need to respond to some of the scale of the impact is not something you could necessarily just tweak with performance improvement initiatives over a few months or even a year. Some of these things will take multiple years to really execute on a strategic transformation. So I'm talking about transactions and finding your portfolio of services, maybe some of the options, but also looking at implementing technology solutions. I know that your audience here has a lot of really strong performing hospitals that do have capital and capability to transform with technology. And so that will be a big component of it. I can't believe how fast AI is developing. I mean, from 1 month to the next, there are improvements that are very material. So it's hard for us to really anticipate what the next 5 years will look like in terms of technology, but it will be a part of healthcare of the future and being able to be sustainable. So I'd encourage leadership teams to model the next few years of impact, quantify the gap, that you'll potentially have, and then think really creatively about the strategic ways that you can position the business to be able to be sustainable in that new framework.
My answer on a closing thought, Morgan, would probably be a little bit more gritty. We did a little bit of research up for one of our clients about, what kind of liquidity hospitals like to have. And the research I did earlier today, just on ChatGPT, said at about 150 days of cash, probably puts you at the low end of the investment grade. The clients that we typically deal with at a topic of a podcast like this don't have that. We sometimes laughingly characterize the amount of liquidity they have is not in days, but hours. Hopefully they have enough to get to lunch. The kind of things we see are a little bit different than the really rich, large hospitals. In 1926, Ernest Hemingway wrote, "The Sun Also Rises." And I think a famous quote from that book was, "How does bankruptcy happen?" And he said, "It happens slowly and then all at once." And that's really what we often see. And one of the things I would just sort of leave the group with is being sensitive to your vendor relationships, because they can turn on you quickly and can cause the situation to unravel on sort of an unannounced basis. Most hospitals and other healthcare providers are dealing with some large companies, and they're also dealing with some smaller companies as well, smaller local companies, maybe regional companies. The larger companies are selling to you, and they're selling to everybody in the market. And they know what you're buying. They know what your consumption rates. They know what everybody's doing. And they know what they probably are. If you have public bonds, they're following your financial reports. And so you shouldn't take for granted that you can continue to push them or stretch them in order to make the next payroll, that they're watching you. And at some point, they will start to restrict your terms. At some point, they may require you to pay COD. And at some point, they may put you on a payment program where they're going to make you pay for, say, 2 orders for them to ship you 1 order. When that happens, when your cash consumption rate is greater than your actual losses, you're in real trouble. And so I think you always got to be mindful of the way your vendors think and put that into your cash flow and liquidity thinking. And with respect to sort of smaller vendors, many of them might be financing themselves on an asset-based line, ABL lending, and their ABL lenders are watching the receivables of your vendor. And when the receivable from you stretches too far, that asset will no longer be sort of an eligible asset for your vendor to borrow against, and it becomes very expensive to continue to sell you on terms. And at that point, they're going to restrict you further. So it can happen pretty quickly. And I think you need to integrate planning with your vendors and your cash flow and be continuously refining it.
I did not anticipate a Ernest Hemingway quote there at the end. So thanks for bringing it home for us. Well, thank you to all of you for joining me and breaking down these critical insights. For our listeners, just wanted to remind everyone that you can download the full report at Gibbins Advisors website. That's Gibbins advisors.com. So thank you all for joining me.
Thank you for listening to Counsel That Cares. For more information on Holland and Knight's Healthcare and Life Sciences team, please visit hklaw.com/healthcare.